Hey, it's Tom Karadza with another Rockstar Real Estate Minute, and here's what's going on right now. We're getting a lot of questions about the real estate market, and with the changes in the amortization length that the Government of Canada changed, that CMHC is reducing from, I think it was a 30-year maximum back down to a 25-year maximum. Is that going to change the real estate market? And here's what I can tell you. And there's a lot of information here, but the real estate market isn't decided by just one sweeping change, and that's not even a sweeping change, that's actually a minor change. I'll explain more in a second. The real estate market is controlled by the dynamics of individual communities. So for example, right now we're in Oakville, Ontario in our new offices here, and in Oakville there is high income, there is population growth, people from Mississauga and Toronto are spilling over into Oakville, and there's transportation improvements. We're right across from the GO train station. The QEW is going to have new exits in Oakville over the next few years. PricewaterhouseCoopers is putting 100,000 square feet new building, so more people are going to be working in this area. So all those factors will determine this particular market. So those are more important for any market you're looking at. You want to look at those individual factors, and those are really much more appropriate to look at for what decides the price of the real estate market. But there can be sweeping changes as well. And the three big sweeping changes that you look for are, will banks continue lending? That's the first one. And banks in Canada will continue lending. Banks are relatively healthy in Canada. They want to lend money. In the U.S., the real estate market really came to a standstill and started dropping when banks stopped lending. We don't have that here in Canada. The second thing is, do they change the mortgage qualification rules? And that really hasn't happened too much in Canada. They've made small tweaks like this amortization period going down from, a maximum of 30 years to 25 years. But that's a kind of a minor change. And you should know that only applies for mortgages that are less than 20% down. So if you're putting less than 20% down, that applies. If you're putting more than 20% down, you can still likely get longer amortization periods. So the third thing is interest rate changes, and that's the big one. Interest rates have been low. They're going to stay super low. They're going to stay low longer than anyone in the media and anyone from the government has been telling us. There's now talk that in Canada they're going to be low for another year. So every year it seems like they're going to be low for another year. So this is going to be an ongoing story. So as long as interest rates are staying low, the Canadian real estate market won't have a big impact. But remember, it's community by community. So if a lot of jobs are lost, for example, in an area, that might impact that particular area, or if the population growth slows. So there's a lot of different factors you look at. These big announcements are really meant to have a little bit of a cooling effect overall, but community by community is really where you decide where the real estate market is going to go in that particular community. And over the last year, we've been doing some really insightful work that we found very helpful for us with what we call Rockstar Market Absorption Data. And that's by looking at the actual metrics of the real estate market in a specific community. And by looking at certain metrics, you can actually forecast where that real estate market is going in that specific community. So if you ever are looking for that type of information, reach out to somebody here at Rockstar and we can help you out with it. Hopefully you found that useful. Until next time, your life, your terms.